We have an investment strategy that actually sets us apart from many of our competitors. We access three different subsectors of the Australian private debt market. First and foremost, we access debt that is involved in mergers and acquisitions and leverage buyouts and private company debt, where we are lending the senior secured piece of that debt, where we have all of the equity that's sitting behind us in that area. So this is supporting large private equity firms that many of you heard of, such as KKR, TPG, Carlyle. Secondly, we are actually investing in asset-backed securities. Asset-backed securities, there are many people that can access the public deals in RMBS markets and other ABS markets, but we uniquely are going to be providing institutional and high net worth investors access to the private side of asset-backed securities, which is the warehouse funding side. Which is a unique side that nobody else, to our knowledge, has been able to offer that in a large way. And then lastly, real estate debt. Real estate debt offers significant opportunities going forward as the banks are starting to get more constrained on their capital regulations. In that way, what we're trying to do in that space is to lend against stabilised property assets. These are to commercial office, retail shopping centres and industrial properties. Where we've got an underlying lease cash flow and we are able to look at a loan to value ratio and cap rates through the cycle. We look to lend up to a maximum of 70% loan to value ratio, where we get comfortable on the underlying value of that asset and the underlying cash flows of those assets. So in that way, we have three distinct and unique asset classes that we look to tap in the private debt markets. And the way that we build a portfolio is that we pick the relative value at any given point in time to find the best possible deal, given the risk-adjusted return, to deliver a return to our investors of cash plus 4 to 5% with the least amount of risk.